Welcome back to Sophisticated Saving. In today's video, we're diving into one of the most insidious threats to your wealth: inflation. You've worked hard, saved diligently, and invested wisely, but inflation can silently erode the value of your savings and investments, leaving you wondering where all your hard-earned money went. Stick around because understanding inflation and how to combat it is crucial for building lasting wealth. Inflation, simply put, is the gradual increase in prices of goods and services over time. It means that the same amount of money buys you less than it did in the past. For example, think about the price of a gallon of milk or a loaf of bread 10 years ago compared to today. The rising costs affect everything from groceries to housing, making your dollars less powerful. When inflation rises, the purchasing power of your money decreases, which is a huge problem if you're trying to save and invest for the future. The challenge with inflation is that it doesn't just affect one area of your finances. It impacts everything. Traditional saving methods, like keeping money in a savings account, may not be enough to keep up with inflation. Even if you're earning interest on your savings, if that interest rate is lower than the inflation rate, you're losing money in real terms. For instance, if you have a savings account with an interest rate of 1%, but the inflation rate is 2%, your money's purchasing power is effectively decreasing by 1% each year. Inflation also affects different asset classes in various ways. Let's start with stocks. Historically, stocks have provided returns that outpace inflation, making them a popular choice for long-term investors. However, inflation can also lead to higher costs for businesses, which can reduce profit margins and, in return, affect stock prices. For example, a company might face increased costs for raw materials and wages, which could squeeze their profits and lower the stock's performance. Real estate is another asset class impacted by inflation. On one hand, property values tend to increase with inflation, which can be beneficial for property owners. Rental income may also rise, providing a hedge against inflation. However, the cost of maintaining and upgrading properties can also increase, which might eat into your returns. It's important to consider these factors when investing in real estate. Real estate investors should also consider the effects of property taxes and insurance costs, which tend to rise with inflation. These additional expenses can impact the overall return on investment for property owners. To mitigate these effects, it's important to regularly review and adjust rental rates to ensure they keep pace with inflation. This way, you can maintain the profitability of your investment properties despite rising costs. Bonds, traditionally seen as a safer investment, can be particularly vulnerable to inflation. When inflation rises, the fixed interest payments from bonds lose value in real terms. For example, if you hold a bond that pays 3% interest annually, and inflation is at 4%, the real return on your bond is negative. Inflation-indexed bonds, like Treasury Inflation-Protected Securities, TIPS, in the US, are designed to help mitigate this risk by adjusting their interest payments based on the inflation rate. So, how can you protect your wealth from the eroding effects of inflation? One powerful tool is compound interest. Compound interest allows your investments to grow exponentially over time by earning interest on both the initial principal and the accumulated interest from previous periods. This snowball effect can significantly enhance your wealth-building efforts. It's also essential to understand the role of tax advantage accounts, like IRAs and 401ks. in your inflation-fighting strategy. These accounts allow your investments to grow tax-free or tax-deferred, maximizing the benefits of compound interest. By utilizing these accounts, you can enhance the growth potential of your investments and better protect them against the eroding effects of inflation over time. For instance, consider an investment of $10,000 with an annual return of 7%. After 10 years with compound interest, your investment would grow to approximately $19,671. Over 20 years, it would increase to about $38,697. This demonstrates how compound interest can help your investments outpace inflation and grow substantially over the long term. However, to truly harness the power of compound interest, you need to start investing early and remain consistent. Regular contributions to your investment accounts, coupled with the power of compounding, can create a substantial financial cushion over time. It's crucial to stay committed to your investment strategy, even during periods of market volatility or economic uncertainty. If you're finding this information valuable, don't forget to subscribe to Sophisticated Saving. Your support helps us bring more financial tips and advice to help you build a secure future. In addition to compound interest, diversification is another key strategy to combat inflation. Diversifying your investments across various asset classes, such as stocks, real estate, bonds, and commodities, can help mitigate risk and provide more stable returns. Different assets respond differently to inflation, so having a well-diversified portfolio can help balance out the impacts and provide a more resilient investment strategy. For example, while bonds might suffer during periods of high inflation, stocks and real estate might perform better, offsetting the losses in your bond investments. Commodities like gold and oil often perform well during inflationary periods, providing another layer of protection. By spreading your investments across different asset classes, you can create a more balanced and inflation-resistant portfolio. It's also essential to keep an eye on inflation trends and adjust your investment strategy accordingly. Monitoring economic indicators, such as the Consumer Price Index and inflation reports, can help you stay informed about the current inflation environment. This knowledge allows you to make timely adjustments to your portfolio, ensuring it remains aligned with your financial goals and the prevailing economic conditions. Another effective way to stay ahead of inflation is by continuously educating yourself about personal finance and investment strategies. There are many resources available, such as books, online courses, and financial seminars that can help you stay informed and make smarter financial decisions. By enhancing your financial literacy, you can adapt to changing economic conditions and ensure your wealth-building strategies remain effective. One proactive approach is to include assets that have historically performed well during inflationary periods in your portfolio. For instance, inflation-protected securities, real estate investment trusts, and certain commodities can provide a hedge against rising prices. By strategically incorporating these assets into your investment mix, you can enhance your portfolio's resilience to inflation. Understanding and addressing inflation is crucial for effective wealth-building strategies. By recognizing how inflation impacts different asset classes and leveraging tools like compound interest and diversification, you can protect and grow your wealth over the long term. Proactive financial planning and continuous monitoring of inflation trends are essential to ensure your investment strategy remains robust and effective. Remember, Inflation is an inevitable part of the economic landscape, but it doesn't have to derail your financial goals. By staying informed, making strategic investment decisions, and leveraging the power of compound interest, you can build a solid foundation for lasting wealth. Thank you for watching Sophisticated Saving. If you found this video helpful, please give it a thumbs up and share it with others who might benefit. Don't forget to subscribe for more tips on investing and building wealth. We'd love to hear about your experiences dealing with inflation in the comments below. Your financial future is in your hands. Take the first step today.